Hello and welcome, ladies and gentlemen. Appreciate you all joining us today in our monthly Outlook session. I am Shikhar Garg, your host, and we will be talking about the major trends and themes that are influencing the markets in this kind of scenarios. Now, we do come on regular basis on YouTube and other podcast channels with our daily market morning updates. But this one's a bit different for you guys. We are talking about the themes and trends which influence the markets for a period of a month, two, or maybe longer. So it's good to have you here, and we are glad you could join us today. Today, on the theme side, we'll be talking more on the inflation, stagflation kind of concepts, which we have been listening to from all the media sources, as well as the potential rate hikes. For example, Fed did come out with a 25 basis point rate hike. And what are the impact of rate hikes in the financial markets? What is expected out of different participants, as well as the geopolitics? So how's it going? What's going on in geopolitics and our views on the market? So I am Shikhar Garg, and I have with me the very talented, very intelligent Mathew John joining us today for this session. Now, Mathew is one of the most brilliant minds that I've come across. And genuinely, he is one gem of a person. The kind of knowledge that he consumes is significantly different, and is the person who is having an experience of more than 2 decades into the industry, sought after by a lot of corporate treasuries, brokerage houses, and a lot of banks in the domestic market. So he's one personality to listen to. So I'm really glad, Mathew, you're joining us today here. How are you doing?
Good. Very good.
Wonderful. So, Mathew, we'll dive straight into our session today without spending a minute more on that. So, Mathew, I understand there's a lot of discussion going on with respect to inflation. And I also remember reading somewhere Ronald Reagan once mentioned that inflation is as violent as a mugger and as frightening as an armed robber. And nowadays, if we are seeing inflation is kind of a worrisome factor for almost all the economies, it's there as one of the most watched after economic indicators. So what do you think? What is this inflation going to stay here for a longer time? Is it sticky? And what would be the actions of central banks with respect to this?
Okay, a lot of questions here. Most important point is that when you look at inflation, the narrative that was put was it is transitory. Now they retired the word transitory. The most important graph that the whole world will be looking at, because a lot of portfolios are built on 60-40, the pension funds and all that, and the risk parity ones. And there are some ones who have invested in Russia and all that with the Russia-Ukraine crisis. All the things are getting into a kind of a level, a kind of a tipping point where it can break out and create violent fluctuations in the currency markets. What we have seen post-Ukraine invasion, or let's say a surgical action or a operation. After that, what we saw is just a kind of a trailer. With what we are having, I mean, are you able to see my screen now?
Yeah, we can definitely.
Yeah, so the screen, I'm put the 10-year yield. Now this, just when Reagan commented on inflation, and Paul Volcker had that Saturday night special rate hikes. Now this is a trend of the 10-year yields. Now the 10-year yields are coming down, and this is known as the great moderation, and the 50-year or 40-year bond bull market and all that. Now it is coming to an end. It was coming to an end around 2019. Then COVID struck, and when COVID struck, they had to cut the rates and do all the QE, pandemic QE, and PPP by the ECB and all that. Now the yields have come down, and then it is now coming up, and it is coming up to a territory where around 10-year, around 2.15, 2.25, it breaks out. That would be the stop loss for a lot of funds, which would be in risk parity and all. That creates enormous fluctuations, because you'll be seeing for the first time, because inflation is high. Inflation is not just persistent, it is going to hit even higher levels. Now, for example, on the monthly annualized inflation that printed last week, it would be around 10% in the US now. Although we see headline YOY at 7.9 and all that. This means that the Fed won't be able to, just because financial conditions are tightening, that is financial conditions meaning bond market and equity market is moving down. they are not going to come and take their or call out their puts. What is called the Fed put, the Bernanke put, Yellen put, the Powell put. The put is far deep out of money. It is not somewhere at 10%, 20%. It will be far, far away, and where the outside spreads and the central banks will come in to collect or help the equity markets. So you will see for the first time, maybe not for the first time, but in a very violent way, like Reagan called, the inflation would be violent in asset prices also. It would be in bond markets, and you will see bond prices and equity prices together falling. And that would have ripples in EM currencies and other risk assets, which have rallied or which would be, especially after the backdrop of the Ukraine-Russia crisis, commodity importers will get hit. And if you look at even the trailer, the currency movements, you will see that currencies further away from Ukraine are the ones which have held steady or which have appreciated. So Australia and New Zealand currencies are the best performing, and the ones near Ukraine, like Euro and maybe Scandi, I have not checked that, but Krona or any other currencies near Ukraine, those are the ones which would have fallen. So it's kind of a casual reference, but the way is that we for INR, from the INR perspective, it would be a very, very tough time for us. We have reserves and all that, but this looks like a very, very potent mix of geopolitics and stagflation that is going to hit the global economy, and in a big way, it will going to hit rupee, because our reaction function, our central bank reaction function, is not just a function of the reserves. It's also a function of RER, and also a function which indirectly or in a big way will be a function of oil prices. So oil prices heading higher with Russia contributing to, let's say, a surplus of 3 million barrels per day. That is out of the market, and maximum you can get out of Iran or whatever they are doing away from the black market. Iran, or even you have a deal with Venezuela. The extra pump, the amount of oil that can come is maximum 1 million barrels per day. So there is a 2 million gap there, which means that the oil price will have a $50 premium on, because of geopolitical or Ukraine risk. On top of that, the ESG risk and all that is one. The trend line, there's an interesting graph here. So why I talked about stagflation.
Actually, Mathew, we'll also need some more understanding on stagflation for the ones who are very new. So please do that as well.
So what I'm trying to say is that since the Fed, see, once the growth comes down, it is normal for the Fed to give a very, very dovish statement and try to get financial conditions to ease out. But this time it is not possible. See, and the most important thing is whenever oil prices goes away from trend. This is a graph I have to give credit to Refinitiv and I think Refinitiv and DataStream. So this is a graph which says that which shows that if prices are moving away $50 from the main trend is around 75, 80. And it's gone higher to around, let's say, $50, then you have a recession which proceeds in the next 4 to 6 months. So it's a very scary graph. So we'll have recession, but the Fed not able to cut. So we'll have, and because inflation will be higher because of commodity supply side constraint. Now we have COVID lockdowns in Shenzhen. We have other kinds of supply constraints that come from Ukraine. If you look at what Romania does, what Hungary does, all the main grain centers or all the channels that ship even base metals or refined metals from Bosphorus Strait, from Black Sea, Bosphorus Strait to the Mediterranean ship. All the shipway is now locked. The Russian Navy is very dominant around Sevastopol and Crimea. So nothing is allowed. You cut Russia, Russia cuts you. So the supply constraints is going to be on top of the inflation, the normal inflation. All this inflation that is measured that came out of the US is pre-Ukraine. Now you are going, when Ukraine thing comes, then it will be far, far higher than that. So the Fed and other central banks wouldn't be able to cut rates, and the inflation thing would hurt us. The whole globe, especially grain importing countries, we will be hurt because we have a lot of dependence on oil imports and import parity price goods. Okay.
So few things that I picked out from what you just mentioned, and I'll just go ahead with the chart which is at display first. I can definitely see that it is not necessary for oil prices to be high when it comes to recession, but we can also see that every time oil prices were there, or every recession had oil prices higher. So it's not exactly connected that recession is necessary having high energy prices, but high energy prices is in a way leading to recession. On the second front, I also noticed you mentioned that the markets are going to have a lot of repercussions. The puts are very out of the money, and there's going to be huge stop losses. So we'll also see a lot of margin calls and loss being taken. This is kind of a situation which is very different from what we've seen earlier. I mean, in the past couple of decades or so of history that we see, if there is any rate hikes within 1 years of time, equity markets have somehow turned out to be positive. But this is a different scenario. Rather, even in current situations, we are seeing all the prices rallying, be it the commodity markets, currency markets, debt markets, equity markets. There's a lot of movement everywhere. So this actually brings on to the next set of questions on the trade front itself. Like you mentioned, there's a lot of supply side glut. We can see a lot of supply constraints. Initially
supply
itself,
constraints,
supply constraints. That's what I wanted to correct. And supply constraints were also there big pre-Ukraine. This is adding on to it.
Yes.
So how would you see trade happening going further? How much impact will have on the trade front and their impact on currency?
See, the point is that we don't have any model, or we cannot look at the linkages of how all these are, kind of affected. How China is linked to Ukraine, for example, semiconductors and all. Even if China eases and China gets out of that COVID thing, for simple semiconductors, you need neon and all that, which is, I think, 60% of it comes from Ukraine and even Belarus. So it becomes, and even if you have let's say a cycle where everything is good, and then you need electric vehicle and or even normal vehicles, which means for catalytic converters you have mix of platinum and palladium, and palladium 46% comes from Russia. So these things are interlinked. And another important thing is, for example, on the currency front, you can look at what payments we are making to Russia. Our S400, the big $7-8 billion of outward flow, that may not happen if US put sanctions, or if we don't have a trade mechanism where we can give that money to Russia. That amount would be saved, or saved. It's just that it won't be remitted out, because there are constraints on banking and the kind of restrictions that come. And most important, the trade front that I've noticed and I've read along after the Ukraine crisis, is that the sanctions that have been announced, these are just announced. There is no law that has come into place. The banks and the financial institutions are putting kind of a self-sanctioning. And that is all the smooth flow of trade that is now getting clogged because of the self-sanction. Any entity that trades with Russia, the banks are not giving any kind of credit. No LCs are open, even for oil, even for metals. So the whole thing is clogging the whole system of credit and financing and the whole trade supply. So this is a very severe thing. I think central banks and all, you cannot model this. You don't know how the linkages are, because any small component will have thousands of small components coming from different parts of different countries. It's very, very. What happens if Russia, the kind of blockade that is happening? You have a kind of this is the first world war where finance is used in a big scale. You used it on Venezuela and on Iran and all that. This is the first world war where you have a financial iron cutter. In that, you have a small playing, like the Ukraine attack, the Russian attack on Ukraine. If you look at, I will just show you the graph. The attack is a small kind of an operation. Of course, some cities are being pressured upon, and maybe their plan is to reduce a few cities to rubble or something. It's a huge humanitarian crisis. But the point is that this is a minor operation considering the kind of, the trade shrinkage that is happening. Now, if Russia puts and kind of close Turkey is the one who is having the Black Sea to the Mediterranean. You have a small strait called the Strait of Bosporus. The Russian Navy is very, very dominant there. So Turkey can cut the Russian Navy. The Russian Navy can, stop all kinds of flows from Bosporus to from the Black Sea to the Mediterranean. That means that you will have stoppage of grain flows. You will have stoppage from any shipment from Romania. It was said that some Estonian tanker was because Estonia just joined NATO. So that is the next, elevation of the whole geopolitical risk on top of a financial world war that is happening. So it depends upon a lot of things. The range of outcomes for us in the financial markets, the range of outcome from equity to currencies to bonds would be far, far higher. It is the probability space that we would be looking for. A small probability space like 5%, 10% is the normal probability, but this is now widened because there are a lot of unknown unknowns that comes, unknown knowns that come. So that will be the probability space. You cannot kind of predict. The normal way we predict rupee will go to here and it come back because RBI is there, but that cannot be done because you have to deal with all these kind of other things. Even the graphs, you will see the graph, it suddenly moves up and it creates a lot of ripples. Then you can't read the graphs because the oscillators and the kind of transforms that we use for technical analysis won't work.
So I actually would definitely agree. I mean, the kind of economic interdependence now we have because of globalization, definitely it would be difficult for us to put on any sort of model when it comes to talking about the direct impact. But I actually love this point wherein you mentioned it's not any rule, but it's kind of a self-sanction. This is an important point to catch, ladies and gentlemen. It is a self-sanction. LCs are also not being opened. So this is where the trade is actually getting impacted. And if we are talking about trade, how can we miss out on China? I mean, China has made itself one of the most pivotal destinations or nations for trade. So, Mathew, how do you see China playing out all of this situation, the whole geopolitics and trade? I see CNY also moving quite significantly.
I think the immediate or the proximate cause of CNY reaction today was maybe mostly because of Shenzhen lockdown. And I think Hang Seng also reacted but China has to, kind of go on an easing path because their economy is hit because of the whole, the financing of, real estate and all the kind of extra fraud that has happened there. So that needs a kind of a central bank cutting rates. So the whole globe will go on a, inflation or on a rate hike path. But China will be the one that will be, cushioning and cutting the. Now, how geopolitics come into play is that whether China will use the whole Ukraine. See, the whole reaction to the Ukraine thing was nothing. I mean, if you look at this graph, I mean, this graph is very, very. The normal TV, television, and the media shows that Russia has conquered all these parts of, Ukraine. But the actual Russian advance is, if you look at the actual Russian advance, it is very, 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 in columns, and these columns are not being attacked directly by the Ukrainians, but the Ukrainians are attacking their supplies, which are easy targets for them. Which with the drone and all that, it's very difficult for holding territory. So this is a modern kind of warfare. Now, China's intention to take over Taiwan may be. I mean, this doesn't look like it is. Although initially it looked like the Russian advance on the first day was like China will also use this to just some troops you getting martyred and you can take over territory. But the use of drones, satellites, every point is being picked up, and the warfare that is going on is at a very, very technological kind of warfare. So it will be very difficult you can advance, but you cannot maintain and hold territory. So that has a very big significance for what China would be. Maybe China will now ease down and be the cushion of the world, and be like, the savior of the global economy. Like in 2008-9, they were with a lot of quantitative easing plus a kind of physical, easing. They helped the global economy to return back. So this would be their chance. Perhaps they would, once they come out of the, the kind of real estate turmoil that they have. But again, the banks that have lent to these real estate companies are all, the companies would be held by the Chinese Red Army and their people. or their formations or their establishments, and the banks who are lender are also from the China. So both are, the owners are the same. So it is not creating a big risk that in time cannot be solved. So it is not foreigners that are, they don't own foreigners. So this can be solved. So it's not a very great or a grave concern, but it requires time. So China can emerge as a savior of, global economy and all that, provided they will have to, ease out on the human rights and, the more of reforms and all that. But that will take time, because if they do that, then they will get another kind of reaction, which again is an unknown. For the time being, China looks in a very good, and their real prices, asset prices, they're also corrected. So there will be a lot of, interest from foreigners to, own those assets. And most important thing is, if you look at the post, from the currency point of view, the post-Ukraine movement of currencies, the CNY and the dollar was the safe haven currencies. So that is something new that happened. Of course, today it has weakened, but before that, the movement was that the CNY strengthened, dollar strengthened, gold rallied, and Bitcoin and all that kind of risk assets. Bitcoin is kind of a risk asset. So all that came down.
So basically, like we see, and Ray Dalio has been mentioning, a kind of change in world order is in place. How much are you aligned with that particular line of thought?
So, big question, above my pay grade. I mean, the point is that, Ray Dalio speaks in a time horizon which is, by the time things come out, we will be old. So, I mean, so those things are coming, but you don't know what will be. China is like what Nassim Taleb would say, an anti-fragile kind of thing. Not an anti-fragile, I mean, a very fragile kind of thing. Which, if they somehow they stop restrictions on the kind of surveillance and all that, the whole, you don't know, it will be a kind of a Soviet Union that broke up. We don't know how the reaction will be, what will be the consequences. So there are very important consequences of this in our FX market and bond markets. One is, I'll just put these slides now. Along this thing, even if the central banks do try to, manage the whole show and try to smoothen the bond yields not moving up, or somehow they, try it with their their verbal job bonding and all that, what their forward guidance and all that, keep things cool. The point is that you have used a weapon of finance. You have used weaponized finance. So the Russian assets the central bank assets were frozen by the European Union and US. Of course, in Russian assets, there was a bit very less. They have been for the last 15 years paring down the assets. But what happens to China? So if the Chinese, say, for every year tries to sell US bonds and US assets, so that means that the whole, Goldilocks or the kind of the great moderation is now over. Because even including India, we need to take out all these things and maybe go into commodities or some other kind of assets as reserves or some link with reserves. So that has a very big bearing, because you use the weapons of the financial Cold War, or the war has just, it began. It is not going to end like the World War. So it will take a long time, because all these things are, so China has 1 trillion or maybe more in US assets, in Japan, in Europe, in UK, in Swiss. So if they are going to, in case China does something on a political level, they need to. At some point in time, their population will become impatient, and they have to show some kind of bravado to, attack Taiwan or something, show something. So at that time, if this is what America does, America will freeze 1.2 trillion of US assets in one stroke of a button. Then that means that they will be in the next coming years trying to, pare down their asset holdings. So that means, again, you have supply of bonds coming in, which means that this line can break, even though central banks will try hard not to. So a lot of things. There's a geopolitical risk turning into a financial risk.
And actually, we've seen a lot of interdependence and, financial tools being also used to fight the war, as we see. And one of the things on the geopolitical front you mentioned, and it was also in sync with what Yuval Noah Harari mentioned, that Russia may try to conquer Ukraine, but it is of consideration how long will they be able to hold them. I mean, it depends on Ukrainians whether they let Russia hold them for a long or not. So where do you see geopolitics finally heading? I mean, this being my second last question to you, where do you see geopolitics heading from now here on, if you can say anything?
It depends upon what Putin exactly has. See, it has been clear that after Putin came to power, he wanted to, bring back what was erstwhile Soviet Union. All the republics, all the 15 republics that went out from Azerbaijan to Armenia to Estonia, Latvia, Lithuania, Turkmenistan, Kyrgyzstan. All these republics, he wanted to have at least a loose coalition, not the loose coalition that CIS was with Yeltsin's time, but to bring back all of them to their fold. And he was able to influence, let's say, in Belarus, which has a very strong ties to, because most of them are Russian speaking and Russian origin, and Turkmenistan, Tajikistan, all that. But the places where they had kind of a proxy government, for example, Romania, Poland, Hungary, all those places went into the NATO fold. So NATO expanded. Russia looked it as, from the Cold War perspective, or from even pre-Cold War perspective, from the time of, Peter the Great and, the whole kind of from the Crimean War. They always hold that all the European allies and their alignment is to conquer Russia, the Slavic mentality. So they will look at that as the conquest of the Slavs, what Hitler wanted, what Napoleon wanted, and failed. So this is what they'll look at. So when NATO expanded, and NATO expanded was that there were a lot of debates in the, with Barack Obama and his Condoleezza Rice and I think Robert Gates. They were all against Ukraine joining or coming to the EU fold or the NATO fold, because that would mean that Russia is kind of seeing this as a grave threat to its existence. Because Ukraine and Kyiv is a center. Most of the Russian kings, I think, their original base is from Kiev. It is a Russian Orthodox Church. It's based in, I think, from Kiev it went. So there is a lot of historic linkages. So the kernel of their civilization is attacked. So for the attacked, or in a way that would be used to put weapons to attack their motherland, is a very grave thing to Russia. So you don't see, although there is some kind of Ukraine being attacked, is being popularly, there are in cities and all, there are a lot of protests and all that. You don't see the old villagers and all the other people coming in. So it is because that they also feel that it is part of their, Ukraine is part of Russia. Of course, Ukraine is a sovereign country. It has its own. That is what we modern, liberal people would think about. But then this has a lot of history in that. So it depends upon if Ukraine is able to maintain the neutrality. They have said that they will not join NATO, and of course they will want weapons to defend them. But it looks like the southern areas and the eastern areas where Russia has put their government, or the Donbass region, what they call, those areas will be kind of a new republics that Russia will annex, and Putin may sell it to his let's say his public, that this is what we have done, and this is why the operation was. This is why so many soldiers had to sacrifice, and this can end there. So it looks like the kind of Russian advance that is happening. And the columns being attacked by modern weapons and satellites and drones and all that, it looks like it is not going to be a prolonged war. The war will end, but the financial war will remain.
So coming on to the final question, Mathew, without taking much time, if we can say or we can see anything more crisper on what we can expect for currencies and the markets going ahead, or as well as gold, if you can say some bit.
See, I think what we will like to see is that, although like we discussed, gold, dollar was the the kind of safe haven or that emerged out of it, and CNY was another one. But CNY might hit because the Chinese economy is slowing down. But the American economy is doing well. There is an inflationary part which may be good for the economy to come out of the rut. But prolonged and persistent one may be difficult. But in the meantime, after the COVID depression or the slowdown, it would be kind of a bit of inflation would help them, and so it is dollar which would be the most ascendant of all currencies, and the ones which are commodity exporters, that will be the next, and which doesn't have any kind of linkages with Europe. So maybe Australian dollar, and those would be the next. EMs which are commodity producing from Australian dollar and Canadian dollar. That would be one pack. New Zealand dollar, that would be one pack. Commodity currency would be one. And then with the emerging market currencies, which are commodity exporters. Like, for example, if Ukraine is Ukraine and Russian, the southern parts of Russia, which produces a lot of sunflower oil and all that. So if sunflower oil prices or sunflower oil is not coming to, because of the all restrictions on Black Sea and all that, is not coming to the market, sunflower edible oil prices are already high. I think in Germany, the prices have doubled. So in India, it's only a matter of time. So we have substitutes. We have substitutes like grain oil. We have substitutes like soybean oil. So that will move up. If soybean oil prices move up, soybean prices moves up. Prices moves up. You will see countries which have had hit. For example, there will be soybean exports from Brazil. So you will see Brazilian currencies all appreciating. Already sugar prices are moving up. So the kind of linkages are very. So these countries which are far away from Europe, which doesn't have big trade as a percentage to Europe, but who are exporters of commodities, even including EM, would be the major beneficiary. So you can see that maybe Colombian peso and Brazilian real are all going to appreciate, but the highest would be dollar and Australia. And Australia has one more effect, which will be, the price of steel and all moves up because of you have many Ukrainian plants which give a lot of pig iron and all that. So Kiwi, Brazilian real, and South American currencies, which are commodity exporters, would be. Countries like India will have to bear the brunt of high oil, high commodity prices, high food inflation won't be a problem for us because we have a lot of buffer stocks and all available, that can be used. But the other part, the edible oil part and the other part, will create a higher inflationary pressure on as we move forward. And the bond yields that we are seeing, it would pressure to move up, and we will be seeing higher rates, but we wouldn't be increasing it in the near future. But that would mean that again, the interest rate differential would go in favor of dollar, and that would again put pressure on the currency. And how RBI manages it would be the most important thing. But the equilibrium rate of dollar rupee kind of shifts from 74, 75 last 3 years, where it was trading, to 70, 74, 75, 73. That range would now shift towards 75, 77, or even a bit higher in the momentary for a few months and then come down.
Okay, so I see that there is going to be some bit of inflationary pressure for our nation, as you mentioned, and the range has shifted. So just to conclude, I'd say a great session, Mathew. I mean, the kind of depth that you go into is currently phenomenally good. I mean, it's always a pleasure to hear you speak, and the kind of insights that we get is something different. And I would just summarize: we are seeing inflation as an animal being unleashed, and it is also in sync with one of the central bankers, UK central banker, who mentioned that inflation is going to be sticky and it is going to stay here for a while, majorly because of the changing demographics, commodity prices, as well as for decades we have had low wages, and now things may start changing. So there are a whole host of factors. We cannot conclude these number of factors in this short period of time, so we might catch up again. Till then, self-sanctions, inflation, geopolitics, everything will be there in place, guys. There's a lot on risk management plate, so keep managing your risk. There's a lot of volatility coming in our way. That was a fantastic session, Mathew. We love to have you here. Hope you guys had fun as well, and the insights were brilliant. Thank you so much. We'll catch up again next week. That's it.
Appreciate it. Thank you.